Hello everyone and welcome to this session. In this lecture, we will discuss IFRS 8 operating segments focusing specifically on three key areas: how operating segments are identified, how segment information is measured, and how it is disclosed in financial statements. Let's start with the definition. IFRS 8 is an accounting standard that deals with how companies report information about different parts of their business, which are called operating segments. Instead of looking at the company as one single block, IFRS 8 asks companies to show how different business activities perform. For example, different products, services, or geographical areas, the same way management sees them internally. Okay, so the main objective of IFRS 8 is transparency. It aims to help users of financial statements like investors, analysts, and lenders understand the nature and financial performance of a company's business activities. By providing segment information, users can better understand performance, risks, and returns of different parts of the business. It also helps users assess the economic environment in which the entity operates. In simple terms, IFRS 8 helps answer questions like where does the company really make money and which parts of the business are growing or struggling. Now let's talk about scope. IFRS 8 applies to publicly listed entities, meaning companies whose shares or debt are traded in a public market. It also applies to entities that are in the process of issuing shares or debt and therefore file financial statements with regulators. For groups, IFRS 8 applies at the consolidated level and it focuses on operating segments reviewed by management for decision making. However, IFRS 8 does not apply to private or unlisted entities, companies with no public instruments, separate financial statements, or not for profit organizations. Okay, so the term operating segments, let's get an overview of it. So, an operating segment is a component of an entity that meets all the four conditions shown on the slide. First, it engages in business activities from which it may earn revenues and incur expenses. This means it is actively involved in operations, not just a passive unit. Then it will be called an operating segment. Second, its operating results are regularly reviewed by the Chief Operating Decision Maker or CODM shortly to assess performance and allocate resources. Third, discrete financial information is available for that component, such as revenues, costs, or profit. And segments can be differentiated on the basis of either their products, services, geographical areas, or a combination of all these factors. Now let's look at a simple example. Assume a company operates in three areas: manufacturing, retail stores, and online sales. Management receives separate monthly reports showing revenue and profit for each of these three areas and uses those reports to make decisions. So in this case, manufacturing, retail, and online sales would each qualify as operating segments because they meet all the conditions listed on the slide. Okay, how to identify the CODM? So a key concept in IFRS 8 is the CODM. The CODM is the person or group that reviews segment information and allocates the resources. So this is not necessarily a single person. It could be the CEO, a management committee, or the entire board. Operating segments are identified based on what information the CODM actually uses and not based on their legal structure. So aggregation of operating segments. Sometimes companies have many small operating segments. IFRS 8 allows aggregation, meaning similar segments can be combined, but only if they have similar characteristics, such as nature of products or services, production processes, customer types, and regulatory environments. So the goal here is to avoid clutter, but without hiding meaningful differences. What would be the example? For example, two retail stores are selling the same products in similar markets. So they can be combined into one segment. Now, what are the reportable segments under IFRS 8? IFRS 8 says not all operating segments must be disclosed separately. A segment only becomes reportable if it meets any of the quantitative thresholds shown on the slide. 10% of total revenue, 10% of profit or loss, or 10% of total assets. For example, if total revenue earned from segments is 1000 and among them segment A's revenue is 120. So if we calculate the percentage, it is 12% of total revenue. So it meets the above condition. Hence segment A is reportable. And there's also the 75% external revenue rule, at least which states at least 75% of total external revenue must be covered by reportable segments. So you see in this example, total external revenue is 1000, but the reported segments have covered only 700. So the percentage calculated is 70%, but the condition says that we have to report at least 75%. So because of this, now the company must disclose additional segment or segments until at least 75% of total external revenue is covered. So if this percentage is not met, they will report additional segments even if they don't meet the above 10% thresholds. Okay. Now, how the segment information is measured? Segment information is measured using the same basis used in internal reports reviewed by the CODM. This means segment figures may not follow IFRS measurement rules used in the financial statements. What is the idea behind it? The idea is show users what management actually sees even if it differs from the financial statements. For example, management may measure segment profit before depreciation, even though depreciation is included in the financial statements. So the measurement methods must be clearly explained in the disclosures, and difference between segment measures and IFRS totals must be reconciled at the end. What are the general disclosure requirements for IFRS 8? So it requires companies to explain how reportable segments were identified, what products or services each segment provides, how segment profit, assets and liabilities are measured, and why segment figures may differ from total company figures. So these disclosures help users interpret the numbers correctly. Okay, entity-wide disclosures. So the entities must disclose revenue for each major product or service, geographical information based on customers and assets, major customers contributing 10% or more of revenue, and these disclosures apply even if there is only one segment. Alright, so for example, if one customer generates 15% of total revenue, this concentration must be disclosed. So there is nothing to hide here. What are the reconciliation requirements? So IFRS 8 requires reconciliations as I told you before. So this means companies must reconcile total segment revenue, to total company revenue, total segment profit or loss to profit before tax, total segment assets and liabilities to total assets and liabilities of the whole company. This ensures transparency and helps users link segment data to the financial statements. So for example, if total segment profit is higher than the company profit, so that difference must be explained. Okay, now coming to the core principles here, recognition. I will explain them briefly since I have discussed in very detail whole concept behind IFRS 8. So the recognition principle requires entities to recognize segment information that is used internally by management. If management uses certain segment information internally, it should generally be recognized for external reporting as well. So the measurement of under IFRS 8 follows the management approach. Segment figures are based on internal reports even if they differ from IFRS accounting principles and later they are reconciled. If internal reports exclude certain costs, segment figures will reflect that. The presentation principle ensures segment information is presented clearly and consistently. Segments should be presented in the same way each year so that users can easily understand and compare them. And disclosure. So the disclosure principle requires enough information to allow users to understand segment performance. Users should understand what each segment does and how its performance is measured. So, in practice, companies often face issues such as defining segments based on legal structure instead of internal reporting, aggregating too much and hiding differences, poor reconciliation with financial statements, and weak explanations of measurement methods. So these issues reduce the usefulness of segment reporting. So in the end, to summarize, IFRS 8 is based on the management approach. Operating segments reflect how the business is actually running. Reportable segments follow clear quantitative rules, and clear disclosure improves transparency and decision making. So understanding IFRS 8 helps users see how a business truly operates, not just its total profit figure. Okay viewers, that's very much it for IFRS 8. I hope you understood the video. Thanks for watching till the end. See you in the next one. Take care. Bye.